Greetings to everyone. Welcome to our tax breakfast. This is our April 17th edition. So we hope that you will have a lot of things to learn from our session today. So today we'll be discussing about tax transfer pricing and the related parties, connected persons, and tax groups. So this is our agenda for today. Now we will start with transfer pricing. So the basics of transfer pricing. So what do we mean by transfer pricing? So this transfer pricing is our rules and methods for pricing transactions within and between enterprises under common ownership or control. In the UAE, transfer pricing regulations are governed by CIT law and are aligned with the OECD guidelines. CIT law enforces transfer pricing rules and documentation requirements to ensure that transactions between related parties and connected persons are not influenced by their relationships. So basically, this is to ensure that everything will be at the arm's length principles or fair market values, not influenced by the control or influence of the owners or connected persons. So arm's length principle, it is based on the Article 34 of CT law. This is the cornerstone of the UAE transfer pricing regulations, which means pricing of transactions between related parties should be set as if parties were independent and operating in similar circumstances. So it means no influence or control over the valuation of each transaction, as if they are working as independent organizations which are not connected to anything or within each other. In the UAE, transfer pricing methods are recognized, but there are only 5 of them based on the Clause 3 of the same article number 34. And these will be comparable uncontrolled price or CUP, resale price method, cost plus method, transactional net margin method, and profit split method. So organizations or companies are free to choose from these methods, but they should be able to justify the circumstances or cases where they can use these transfer pricing methods based on the situation of the company. The selection of most appropriate method depends on the facts and circumstances of each case and must be documented and justified if asked by the FTA. The authority has the power to adjust anything that is affecting the taxable income in order to meet or achieve the arm's length result. So even though the companies will have other methods, or if they violate the arm's length principle, still the FTA has the authority or power to adjust everything when you are filing your tax return in order to have the same effect as if there is a transfer pricing method applied in order to achieve the arm's length principle rules. Next. In transfer pricing, documentation is also regulated by the law. So documentation requirements based on Article 55 of CT law, there are 3 levels. First, TP disclosure form, which is filed alongside the CT return, which will be disclosing the related party transactions and connected party transactions or connected person transactions. For related party transactions, aggregate value over 40 million and per category value over 4 million need to be disclosed. And for connected person transactions, aggregate value over 500,000 also per category value over 500,000 needs to be disclosed. So I think in the current system of the CT filing, it's already integrated, but we will be able to know it once we actually do it. So the second level will be the master file and local file. This will be as requested by the FTA. So when FTA requests for these files, the company should be able to provide it within 30 days. And who must prepare this. These are a taxable person which has revenue of 200 million or more, or if a taxable person is a member of an MNE group with total consolidated group revenue of at least 3.15 billion. And the third level will be the country-by-country report, or the CBCR, which will be filed within 12 months from end of the reporting year of the MNE group. UAE headquartered MNE group with consolidated revenues above 3.15 billion needs to prepare this third level of documentation. So that's it for the transfer pricing. Thank you. So the next topics will be discussed by Mr. Rehman Imtiaz.
Thank you, Maria. Hi, good morning. Thank you for justifying the transfer pricing method. It's very common problem because everyone facing transfer pricing basics issues. So my topic is related parties. Who is the related parties? For natural person, definition of related party is two and more natural persons who are related with in the 4 degree of kinship or affiliation, including by the way of adoption or guardianship. Means 4 degree for natural person means for me 4 degree up and 4 degree down. For me 4 degree up is my parents, my grandparents, my great grandparents and my great great grandparents, 4 degree up, and 4 degree down means my son and son of his son, and his son means 4 degree down as well, 4 degree up and 4 degree down. So they need to be justify that no related party will affect on the transaction of the business. So you have to be take care of the related party by the natural persons, and related party for the juridical person is if alone and with related party directly or indirectly own more than 50% of the another juridical persons or exercise control over it. A person alone with or with the related party directly or indirectly own 50% or creator ownership interest or control such 2 or more juridical person. Means a juridical persons own more than 50% by himself or independently. For example, if I own one company and that my another entity owns that another entity, I own B and B owns C. I indirectly own 50% of the of C. If I own 100% B and B own 50% of the C, so I indirectly own 50% of the C company. So that means that C company is also related company, related party with me, because I indirectly own 50% of the share of that company. So it means directly or indirectly. If you are owning directly or indirectly to more than 50% of the company, so it means you have to be, this is your related party. So that means normally people say that if I own indirectly, it does not affect the related party. It does not mean. They say clearly that directly or indirectly, both way, if you own more than 50% of the shareholder, you are the related party of that company. Definition of related party is person and his permanent establishment or foreign permanent establishment, 2 or more persons who are the partner in the same unincorporated partnerships, a trustee, founder, settler or beneficiary of the trust or foundation or his related party. Means anyone who is effect on the transaction of the company, who is a close relation of the company, person and his permanent establishment. For example, me and my permanent establishment also related party for me. And 2 or more persons who are partner in the same unincorporated partnership means if we set up an unincorporated partnership, in tax point of view, unincorporated partnership is a transparent. They don't see the unincorporated partnership. They see the partners of the who is in the partner of unincorporated partnerships. So that person who is the partner of incorporated partnership, so they are also related party of them. Control is the ability to influence another person to exercise more or 50% or more of the voting right of another person's, determine the composition of 50% or more of the board of director of another person's, receive 50% or more of the profit of another person's, determine or exercise a significant influence over the conduct of the business or affair of another person. Means if you are controlling someone else, if if I have a more than 50% share of any company, so it's influenced by me. The decision which I took by its influence over there. For example, if someone is saying that you have to pay the salary of 10,000 dirham, if I say you need to pay 50%, 50,000, so I am influencing the transaction in that company. So this is my control in that company. So this is also affect in the related parties. Payment or benefits provided by taxable person to connected persons shall be deductible only if and to the extent of corresponding to the market value of the service benefit provided wholly or exclusively for the business. Arm's length principle, Article 34 of the City Law shall apply to determine that the payment and benefit provided to connected persons corresponds to market value as the context required. As explained by Maria in the transfer pricing method, that only you have to be put the value in arm's length principle. If, for example, I am connected person for someone, and in market my salary is my expected salary is 10,000 dirham, but I am the connected person. He is giving me 50,000 dirham to saving the tax. This is not in law. You have to be give the salary arm's length principle. You have to be compare your salary with other person as well. So if FTA is come in audit your transaction this one, so you have to be justify. If you cannot justify, then you have to pay the penalties. FTA also amend the figures and take the more corporate tax liability, and other is they also put your penalty over there as well. So transaction with the connected person should be on an arm's length principle. So be careful for this one, because a lot of people is doing this, increasing his lot of salaries and increasing the putting his son and putting other person in the company to giving him in a salary for saving taxation. It's not like this. You have to be in a market, you have to be pay him in a market rate, not in more than a market rate. So definition of the connected person is a natural person who directly, indirectly own an ownership interest or control of the taxable person, director or officer of the taxable person, partner of the same unincorporated partnerships, related party of any of the above. Means I already explained that connected persons, who is the connected? A natural person is connected directly with the company. He is owned by the company. He's as a natural person is a 4-degree relationship, 4-degree up and 4-degree down. If any one of them is in the company, so he is a connected person of that one. So you have to be careful that one, if connected person is not getting more benefit by unconnected person. For example, if unconnected person is getting 10,000 dirham, so connected person and should also be get a 10,000 dirham, not more than this. So it should be an arm's length principle. So this is the connected persons, Article 36 of the City Law. So the next topic our is tax groups. The first point of the tax group, normally people is confusing that VAT law and City law is the same. It's not like this. VAT and City law is opposite. City law is optional for you. It's not compulsory you have to go for a City law. There is some benefit and there is some disadvantage as well of the tax grouping. So the tax grouping of VAT tax grouping and corporate tax grouping is totally different. It's not the same. That a lot of people is saying that tax group of VAT is automatically a corporate tax group. It's not same. You have to be registered separately. Then you have to be applied to the FTA that this is our parent company who is the responsible of that one. Then tax group will create by the FTA. If FTA approve the application, then you have to be create a tax group. So UAE group entities may elect to form a tax group if the following conditions are met. Parent company which must be UAE tax resident person, including a foreign legal entity which is with the UAE POIM, directly or indirectly hold at least 95% of the share capital, voting rights and entitlement to profit or net assets. They have the same financial year, prepare the financial statement using the same accounting standards. Neither the parent company and the subsidiary is an exempt person or a qualified free zone persons. Means for tax grouping, you have to be owned by 95% shareholding of the company, not less than that one. If directly or indirectly, if you are holding 95% of the company of the shareholder, then you can apply a tax grouping, but not less than 95% of the tax grouping. Sorry, 95% of the shareholding. If you are less than 95% of the shareholding, you cannot create a tax group. As I told already, it's optional. So before going for the tax grouping, just be careful about your analysis by your own internally every company, that is advantage for the going for the tax grouping or no. So you have to be same financial year, same accounting standards. So it's not like there's one company is using cash basis and another company is using accrual basis. So if parent company is using accrual basis, so in the group member also use accrual basis, not going for another standards. So you have to be same accounting standards, same financial year end. When the tax group is formed, the parent entity will be responsible for the admin such as submission of the one tax return and settlement of the tax liability for the tax group. Means as in advantage of the tax group is you have to submit one tax return, all the entities, and the second advantage, main advantage is intercompany transaction should be eliminated. So if you create a tax group, so one tax return will be sufficient. So the parent, who is the responsible for the tax group return, parent company is the responsible for tax group returns. Note that CT group composition may be different from the VAT group composition for the same group structure as the group rules are different. Yes, I already told you that CT group and VAT group is totally different. It's optional for you if you go for a CT group. So if you are already a VAT group, it's not compulsory you can go for a CT group. It's optional for you. If you want to go or no, this is your decision. The main disadvantage of you have only 375,000 dirham relief. This is the main disadvantage if you have a small business, if you are a small entity. You just think about that if you have if you want to go to a tax group or no. That's why I already explained that go internally assessment that if you want to go for a city group or no. So if you have any question or answer, just let us know. Thank you.